In this presentation, we're going to enter an adjusting entry related to breaking out the short-term and long-term portion of a loan. This time, having a loan that has both a short-term and long-term portion, we will need to be breaking out with the help and the use of an amortization table. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to be starting off by opening up the old balance sheet by going to the accounting dropdown and scrolling down to the balance sheet. Once opened, we're going to duplicate by going to the tab up top, right-clicking on that tab up top, and duplicating it. We'll then change the date to the cutoff date, which is going to be the end of February. So we're going to bring this out to February and February 29th and update that report. Now I'm going to go on down and see what our objective is. We had this remaining account in liabilities in terms of the long-term liability for a note payable. We broke out the last note payable because all of it was short-term. So we're putting our note payable down here, we're breaking out the short-term portion, and we're putting it up top. Last time it was a little bit easier because the whole thing is due within a year, and therefore we put the whole thing up top. This time, we have an item that's just kind of normal type of transactions for financing where we have a short-term and long-term portion of it, and therefore would need an amortization table to break it out. What we will do is break it out for reporting purposes for the cutoff date, and then I'm going to reverse that, bringing it back into this format for our just accounting purposes, because logistically, it works well for me to have it in one account so that I can then track the payments and the interest and principal portion. However, to properly record on an accrual basis or for generally accepted accounting principles type of accounting, we would need to have the current portion broken out. So I'm just going to do that periodically when we need to report, when we need to, give the report to somebody. So to do that, we have to have an amortization table now. We've seen the creation of the amortization table in the past. We won't recreate the amortization table, but in essence, you see we have the loan amount, we have the amount of payments, and then we have the actual payment. This payment is going to be broken out between interest and principal portion down here. As you can see, interest and principal portion. We've made two payments. Therefore, at this point in time, the original loan was 72. We're down to the 69,878. That amount is correct over here. We have it over here, 69,878. That's correct. There might be some rounding difference, but in essence, that's correct. So that is good. However, it's all in long term, and we need to be breaking out the short term and long term portion. Anything that's going to be due within a year is going to be short term. Now, you might think, well, that'll be easy because all I have to do is take that 1357.59 and multiply it times 12, because that's what's going to be due within a year. But it's not that simple. Like, why isn't it that simple? Because part of it is interest, and you can't, and so we're not going to be, even though we know we're going to pay it in the future, we can't record it as a liability now. Why? Because that would be similar to us, like let's say that we were renting a building and we were renting our place of business, and I know for sure that I'm going to be paying rent next month, but I can't record the rent now, even though I know I'm going to budget it next month, but I can't record it next month as an expense now. Because I haven't incurred it yet. I haven't used the facilities, therefore I shouldn't be recording the expense related to the business, the business area that I would be using. The same is true for money. So in this case, we rented the money in essence here. So for us to be recording the interest expense that's going to happen in the future would be like us recording the expense of something that hasn't happened yet, right? We haven't earned it. We haven't incurred the expense. So we have the same problem there. So I can't just take this amount and multiply it times 12, and because the interest and principal portions are not the same for every payment, I need an amortization table. So what I'm going to do is I'm going to take my amortization table and I'm going to say, here's the next 12 payments down here. I can count out 12 payments. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I don't want the payment column though. I want the principal column. This is going to be the amount of reduction in principal. So this then, I'm going to highlight these in yellow. That's going to be the amount of our payments that will be reducing the principal, not including future interest that's going to be part of the payments we'll be making. So I'm going to sum this up then. If I was to say then that the short-term portion, let's say it's going to be equal to the sum of these yellow items. Those are going to be our reduction. So I'll make that yellow. So these are the yellow items. And that means the long-term portion, this is where we are at now, minus what's going to happen in the short-term portion, will be where we will stand after a year's worth of payments. meaning that's where we will have the long term. That'll be the long-term portion. In other words, the 69,878 minus the 13,109 brings us to the 56,770, which should match this number, meaning our balance after 12 payments, which is where we'll be a year from now, which at this current point in time, anything above that would be long-term. So we then need to be breaking out. This is where we're at now. We're going to break out the current portion, which was 13,109, which will leave us with the long-term portion. Journal entry then will be decreasing the loan balance by the 13,109, decreasing back to zero here, decreasing this amount by the 13,109, the short-term portion, and putting the long-term portion into, decreasing the long-term portion, putting the short-term portion into this account we already set up last time. We set up one account for the current portion last time. It's going to include multiple loans if we have multiple loans, because it's just for reporting purposes. And then I'm going to reverse that for logistical purposes as of the beginning of the next month so that we can have our loans listed down here like we like to see them. Okay, so let's do this transaction. We're going to do a journal entry. Let's go back to the first tab. We're going to then go to the accounting dropdown. We're going to take a look at our reports. We're then going to go down to our journal report down below. So we want to look at our journal report because that's where I can get to the general journals, which we need to enter. And so I'm going to enter an add new journal. So we're going to add a new journal here. And this is going to be, I'm just going to call it ADJ, adjusting entry. I just want to make sure I label them as adjusting entry. I might want more detail than that in practice, but I for sure want to say, hey, look, this is an adjusting entry. This isn't something the accounting department does as part of the normal process. This is something we're doing to fix, to adjust the books. Not really to fix them. It's part of the normal process. We're doing it to adjust the books as of the end of the period as part of our normal kind of adjusting process. So then we're going to say that this account, back over to this one with the 3458 needs to go down. So it's going to go down by the current portion because this is the long-term portion. We're going to make it go down. So it's going to be notes payable with the 3458. It needs to go down. It's a credit balance account, so it's going to go down by doing the opposite thing to it, a debit. It needs to go down by the 13,109. So I'm going to say 13,109, was it? I forgot already. 13,109. There it is. I was right. We were right on that one. And then it's going to be going into the current notes payable, current portion. Again, liability account, credit balance. Therefore, it's going to go up with a credit. So what's this going to do? Decrease the long-term portion and increase the current portion. So let's go ahead and post that and see if that is indeed what happens. Posting it, going back to the balance sheet to check it out. And once we enter this, what's going to happen once I update, that number is going to go down to this number, 59,770, hopefully. Maybe a rounding difference, but we'll update the report, see what happens. We scroll back down. It's a tense moment. Is it going to work? 56,769. Is that what's over? 56. See, it's off by $1 because that's rounding because there's actually pennies involved here. So that's okay. I'm good. I'm okay with it being off by $1. That looks good. And then up top on the current portion, we now have the 63,109, which is the current portion of the two loans that we have. So remember last time we entered the one loan, which was all current, the $50,000 loan, plus the current portion of this loan, which was the 13,109 for the total of the 63,109. For this particular loan, we're picking this item up. So there we have it. And we've reallocated those. Now, for presentation purposes, we may want to, adjust this report for where, the ordering of the accounts we may want to adjust for if we so choose, or we may want to remove this account number on the end. Even though there's only one account left down here, we may want to say, hey, I don't like that account number showing up. Maybe I want to make an external report, and we can go to the edit layout to do that. And I would just say, all right, this one down here, this is my external report. I don't want these. Now, there's only one that has a balance in them, but I'm going to group them all together. I'm going to say these. I would like to just, if there's anything in there, I want to group them together in just one account called notes payable. And then I can add that group and then close this up. And now there's no account number. And so I could then say done. I'm not going to save this, by the way. You could save a report like this. I'm just giving you some ideas. Next time we open the balance sheet, it won't be in this format, but just to give you some idea of how you could format that now the notes payable is gone. I can have an internal report that has the notes payable with the numbers on it, and then an external report that has them removed in this format. So that's it for now. Let's get out of here.